Here's the scoop. Dow futures are trimming down, S&P 500's perked up, and Nasdaq's on fire. But brace yourselves. February's inflation data is on the horizon. It's like the cliffhanger of your favorite show, but with more money talk and less popcorn. Welcome back to Stock Whispers, your gateway to investment brilliance. Today, we're diving into the mixed signals from US stock market futures ahead of some spicy inflation data. So, buckle up, grab your calculator, and let's get into the nitty-gritty without making our brains hurt too much. Early Tuesday, the Dow Jones Futures showed a slight dip of 30 points, or 0.1%. It's like they're on a mild diet, shedding just a tiny bit of weight. On the other hand, the S&P 500 futures perked up, rising 0.2%, while the Nasdaq Composite futures gained 0.4%. Looks like the tech sector had its morning coffee and is ready to tackle the day. But what everyone's really waiting for is the February's Consumer Price Index data. Economists predict a headline inflation rise of 3.1% annually. It's like saying, hey, prices haven't cooled down from January's heat wave. Not the news you want to hear if your wallet's been feeling light lately. ING's Benjamin Schroeder suggests a slight uptick in monthly inflation to 0.4%, with core inflation potentially cooling to 0.3% month on month. The Fed might still be biting their nails, thinking, this is hotter than we'd like. They're like Goldilocks, but nothing is ever just right. Now let's peek at the bond market. The yield on the 10-year Treasury note is lounging at 4.100%, seemingly unfazed by the market's workout. It's chilling there, like someone who's decided to take a day off from the gym. Now for the specifics. The E-mini Dow is at 39,141 US dollars, down just a whisper at 0.03%. The E-mini S&P 500 is barely moving the needle, up 0.01% at $5,183.25. And the E-mini Nasdaq 100 is up 0.03% at $18,063.75. Tech sector is showing up after all. So what does this all mean for you? The stock market is like a box of chocolates. You never know what you're gonna get. With the upcoming inflation data, traders are guessing how the Federal Reserve will react. Will they tighten their belts and raise interest rates, or take a laid-back approach? Only time will tell. Now, let's take a closer look at the factors influencing these market movements. Grab your magnifying glass, folks, because we're diving deep. It's essential to understand that the stock market is a complex ecosystem influenced by a myriad of factors, both internal and external. From economic indicators to geopolitical events, every piece of news has the potential to send ripples through the market. One of the most closely watched economic indicators is the Consumer Price Index. This measures the average change in prices over time for a basket of goods and services, providing insight into inflationary pressures. A higher CPI suggests the prices are rising, which can erode purchasing power and lead to concerns about future interest rate hikes. When it comes to interpreting CPI data, analysts pay particular attention to the core CPI, which excludes volatile food and energy prices. This gives a more accurate picture of underlying inflation trends, helping policymakers make informed decisions about monetary policy. Speaking of policymakers, let's talk about the Federal Reserve. As the central bank of the United States, the Fed plays a crucial role in shaping the country's monetary policy. Its primary mandate is to promote maximum employment and stable prices, which aims to achieve through interest rate adjustments and other monetary tools. When inflationary pressures are rising, the Fed may respond by raising interest rates to cool down the economy and prevent runaway price increases. Conversely, when inflation is low, the Fed may lower interest rates to stimulate borrowing and spending, thereby boosting economic growth. Over the years, we've seen how changes in interest rates can have a profound impact on financial markets. Higher interest rates tend to dampen stock market returns as borrowing becomes more expensive and consumers cut back on spending. On the other hand, lower interest rates can fuel a bull market as investors seek higher returns in riskier assets like stocks. So, what do all these economic indicators and monetary policy decisions mean for today's market? Well, it's like trying to predict the weather. There are no guarantees, but we can make educated guesses based on the available data. As we navigate these uncertain times, it's essential to stay informed and keep a close eye on market developments. Whether you're a seasoned investor or just starting, understanding the factors driving market movements can help you make better informed decisions and achieve your financial goals. So, there you have it, folks. A mixed bag of market movements as we await the inflation data that could shake or stir the Federal Reserve's next moves. It's like waiting for the season finale of your favorite show, but with more economic jargon and less popcorn. Remember, whether the market's going up, down, or sideways, we'll be here to break it down for you in plain English, with just a dash of humor to keep things interesting. After all, who says finance has to be dry and dull? Thanks for tuning in to Stock Whispers. If you enjoyed this video, give us a thumbs up, subscribe, and hit that notification bell so you never miss out on our expert investing advice. Until next time, keep listening to those whispers and let them guide you to your next big win. See you soon!